Silver just fired a supply warning shot that the paper market can't mute anymore, and the most aggressive voices trying to wave it off are leaning on the one thing that matters least in a stress moment. The headline, spot, quote, "Because when silver moves the way it just moved, ripping from the low 70s into the mid 80s in a matter of sessions, printing fresh records along the way, it stops behaving like a sleepy metal and starts behaving like a margin instrument with a delivery clock attached. And that's where the real pressure starts. The conflict right now is simple and brutal. The screen says, plenty of liquidity, but the physical chain is telling you, quietly and consistently, that demand isn't cooling the way the models want it to. And later in this video, I'm going to give you the exact set of tells, level spreads and calendar triggers, that decide whether this turns into a controlled retest or a continuation squeeze that forces buyers to pay up into thin air, because if one level breaks, the math changes. Start with the price, but don't worship it. Price is the last thing that updates when the plumbing is stressed. The plumbing changes first. Early this month, silver didn't simply trend higher, it lunged. That matters because speed is information. Slow moves are opinion, fast moves are positioning getting repriced, liquidity thinning, and hedges being adjusted under time pressure. In a fast move, the market doesn't give everyone a clean exit. It creates winners by forcing someone else to do something they didn't plan to do today. But that's not the part that matters. The part that matters is what participants are forced into next. Dealers rehedging, shorts recalculating risk, and physical buyers making a decision that can be deferred by a tweet or a talking head. Silver is one of the few assets where paper and physical can drift apart in a way that not philosophical. It mechanical. It's about timing, location, and deliverability. And the reason this warning feels louder now is that multiple pressure channels are converging at once. Safe haven demand on the macro side, industrial pull on the real economy side, and a structural friction in where the metal sits versus where it's needed. The next detail is what flips the whole setup. Here was what the mainstream tends to miss when silver gets loud. They obsess over whether investors are excited, as if excitement is the engine. But excitement is usually just the match. The engine is physical behavior. And right now, physical behavior isn't blinking. When a market is truly cooling, you don't just see it in price, you see it in availability and urgency. You see it in the way buyers respond to dips. You see it in the way premiums compress and delivery times normalize. You see it in the way dealers stop rationing product, the way the in-stock signs come back, the way the retail pipeline stops feeling like it's always one weekend away from empty shelves. If physical demand were actually fading, the easiest place to see, it would be in the small stuff, coins, bars, and the steady dribble of buyers who don't care about the day candle and only care that they can get metal in hand at a reasonable spread. But what's been sticking out in this market is that even as prices have surged, the physical side has been stubborn. That's not a guarantee of anything, and it's not a magic spell. It's simply a symptom. And when symptoms stack up, you pay attention, because symptoms are what the market shows you before it tells you a story. Now, to be clear, silver can whip around violently even if the underlying thesis is correct. In fact, that's how silver usually behaves when it's tight. It punishes certainty. It punishes leverage. It punishes anyone who confuses trend signal with noise. The signal is structural. How supply responds, how spreads behave, how inventory is categorized, and how arbitrage either heals dislocations or fails to. The noise is the daily emotional roller coaster designed to pry weak hands out at the wrong time. And yes, volatility itself is a weapon that gets used against you, especially when you're right. We're going to build a psychology shield for that, because most people don't lose money in silver because they can't read a chart. They lose because they get emotionally reverse engineered by price swings. But first, let's talk about the hidden detail that reframes the entire story. Here is the underappreciated mechanism that keeps turning silver is up into silver is unstable. The stress isn't necessarily that the world is out of silver. It's that the metal is stranded in the wrong places at the wrong time. This is the kind of detail that sounds boring until you understand what it does to price discovery. The benchmark market, where a lot of contracts, hedges, and pricing references get anchored, depends on metal being available where it's supposed to be available when it's supposed to be available. If a significant amount of physical supply migrates to a different region because participants are trying to avoid policy risk, tariff risk, financing risk, or delivery uncertainty, you can get a situation where headline inventory totals look fine, yet the float that can actually be mobilized on a tight timeline is not fine. And that's where silver becomes explosive, because the market doesn't need a global shortage to squeeze. It only needs a local shortage at the pricing hub, plus a delivery clock, plus participants who promise liquidity they can't source on demand. And that's not a conspiracy. That's incentives and constraints colliding. Let's make that real. Inventory is not one number. Inventory is categories. Some metal is deliverable. Some metal is registered for delivery. Some metal is eligible, but not actually available because it's owned by someone who isn't T selling, or it's pledged, or it's sitting in a form that doesn't match immediate delivery needs without time cost and paperwork. The market can print a big total and still have a tight float. Think of it like a stadium. The total seats might be enormous, but if the exits are narrow and everyone tries to leave at once, the constraint is the exit, not the seating capacity. In silver, the exit is mobilization, moving bars from one vault ecosystem to another, meeting specifications, navigating settlement conventions, and doing it on a timeline that doesn't care about your excuses. And that's where the real pressure starts. Now fold in something else. When policy uncertainty rises, participants get defensive. They front-run potential changes. They shift metal preemptively. They choose my vault, my jurisdiction, my control, over optimal global allocation. That can make the market look calm right up until it doesn't. Because calm on the screen can coexist with stress in the chain. And when stress in the chain persists, price becomes sensitive. Not just higher, sensitive. Small incremental demand can cause outsized moves. That's the setup we are dealing with now. A market that has become more jumpy because its flexibility has been reduced. And once flexibility is reduced, volatility is the natural language. This is where term structure comes in, because if you want to separate hype from tightness, you stop staring at the headline spot print and you ask, what is the curve saying? In a well-supplied market, carrying metal forward in time usually costs something. Storage, insurance, financing. That often expresses itself as a gentle contango. Future prices slightly above spot. In a stressed market, the opposite can happen. The market pays you to have metal now that can show up as backwardation, or at least as unusually firm nearby spreads. You don't need to become a derivatives wizard to understand the point. If the market is willing to bid up immediate delivery relative to later delivery, it's telling you immediacy has value. And immediacy only has value when something is tight, stranded, or in sudden demand. But that's not the part that matters. The part that matters is what it forces participants to do. If nearby spreads firm, rolling positions can become painful. Dealers managing books have to adjust hedges. Arbitrageurs try to move metal to capture the spread. Industrial users may pull forward procurement to avoid getting caught in a squeeze. And shorts who assumed they could calmly buy back later discover that later is more expensive than they budgeted for. This is how a market turns from a debate into a stampede without anyone announcing it. Another stress gauge is leasing and borrowing. Again, not because it's mystical, but because it measures willingness. When borrowing metal is cheap and abundant, lease rates tend to be sleepy. When holders of physical metal start demanding a real premium to part with it, even temporarily, that's the market admitting the supply cushion is thinner than it looks. It's a form of price that doesn't always show up in the spot headline, but it shows up in the cost of accessing metal. And the reason that matters this week is simple. Higher financing friction reduces how quickly arbitrage can heal dislocations. If it costs more to borrow metal and ship it and reassay it and deliver it into the right system, the threshold for easy fix rises. And when fixes are harder, price has to do more work. Because if supply can't move smoothly, price must move aggressively enough to force behavior changes. That's the real mechanism behind violent repricing. Not drama, but forced adaptation. Now let's talk supply chain, because silver is not oil and it's not software. You can't just crank a lever and produce more on demand because price ticked higher. A meaningful portion of silver supply is tied to other mining economics. It's often produced as a byproduct of base metals. That means the supply response depends on decisions made for copper, lead, zinc, and other ores, not just for silver. So even if silver screams produce more, the industry can't instantly comply. You have lead times. You have refining capacity constraints. You have logistics and assay bottlenecks. You have contracts and processing schedules. You have the reality that recycling ramps with lag and depends on collection, incentives, and the availability of scrap at the right price. In other words, the supply side is sticky, and in a sticky supply environment, persistent physical demand doesn't need to explode. It only needs to refuse to cool. The next detail is what flips the whole setup. If demand stays steady while supply can T-flex, price must ration. That's how markets clear. And silver has something else that makes this different from a simple fear trade. Or worse, it sits at a crossroads. It asks a monetary metal in how people treat it when trust cracks. And it's an industrial metal in how the world consumes it when production lines run. That dual identity matters because it makes demand resilient from multiple angles. When macro stress rises, geopolitics, policy shocks, rate uncertainty, non-yielding assets can get a bid because they're not someone else's liability. When industrial demand is steady, electronics, solar, specialized applications, there's a baseline pull that doesn't disappear just because a trader got spooked. Now, I'm not going to promise you a straight line higher. Silver doesn't do straight lines. It does staircases with trapdoors. But when you have multiple demand channels pushing while supply flexibility is limited, the market becomes prone to episodes of tightness. And tightness is the mother of spikes. Institutional behavior pours gasoline on that dynamic, even when flows aren't historic. In a normal market, steady buying can be absorbed. In a strained market, steady buying becomes a wedge that pries the price open. Why? Because the marginal seller disappears. Holders don't feel compelled to sell into the first uptick. They wait for better prices, especially if they believe the setup is structural. That reduces float further, so the same quantity of buying that would have been a rounding error months ago becomes meaningful. And here's where people get fooled. They think price only moves when there acts some massive new buyer. In tight markets, price moves because the market structure can't easily meet existing buyers. It's the difference between demand surged and supply failed to show up. That distinction matters because it changes what you watch next. If the move is pure demand surge, it can cool quickly when enthusiasm fades. If the move is supply failing to mobilize smoothly, it can remain unstable for longer, with violent back and forth, until the logistics and policy uncertainties unwind. Now, let's put a name on the calendar trigger, because why now is never just because people noticed. This week, the calendar starts acting like a participant. You have thin liquidity pockets early in the year where positioning resets and books get rebuilt. You have the ongoing rhythm of futures roll decisions and delivery windows where participants who done T want to take delivery must move, and participants who do want physical may press advantage. You have options-related hedging dynamics where certain strikes become magnets or tripwires, forcing dealers to buy into strength or sell into weakness depending on their net exposure. You don't T need to memorize Greek letters to understand the effect. Options can turn price into a reflexive machine. If the market rises through key levels where large open interest sits, dealer hedging can amplify the move, which then pulls in trend followers, which then pressures shorts, which then forces more buying. That's not a fairy tale, it's just mechanical feedback. And if this one level breaks, the math changes. Here's how to think about the two biggest mechanical amplifiers without getting lost. First, short covering and margin pressure. And when silver rips higher quickly, shorts don't just lose on paper, they lose collateral. Their brokers and risk managers care about volatility and drawdown, not their ideology. So rising price plus rising volatility tightens risk limits that can trigger forced reduction, buying back into a rising market. Forced buying is the purest fuel because it's not price sensitive. It doesn't wait for a dip. It executes because it must. Second, dealer hedging around options. If dealers are short options exposure, rising price can force them to buy underlying to stay hedged. That buying can be incremental but relentless, and it tends to cluster around levels the market already cares about. Those are the moments when silver feels like it's being pulled upward by a rope, not pushed by a crowd. But that's not the part that matters. The part that matters is what happens after the rope pull. When price pauses, the market tests whether demand is real or merely mechanical. That's where physical signals and spreads become the judge. So, what are the proof points you stack to decide whether this warning is real right now, this week? You look at least 5 layers, and you don't let any single layer hypnotize you. Layer 1 is term structure and nearby spreads. Do they remain firm, implying urgency, or do they relax as supply flows heal? Layer 2 is borrowing and financing stress. Are lease type indicators elevated, implying holders are reluctant, or do they normalize, implying metal is becoming easier to access? Layer 3 is vault and inventory reality, but with nuance. Not just how much exists, but how much is mobilizable, and whether the distribution across key hubs is improving or worsening. Layer 4 is physical premiums and availability in the real world. Do dealers report persistent tightness, and do premiums compress when price spikes, or do they stubbornly stay wide because demand is absorbing supply? Layer 5 is cross-market comparison. Do regional quotes and implied premiums suggest fragmentation, or does arbitrage quickly close gaps? And layer 6, because you always want more than 5, is chart structure. Does silver hold key breakout zones on pullbacks, or does it lose them and confirm that this was a blow-off rather than a regime shift? Proof stacking is how you stay sane when the tape gets emotional. Now, on vaults and inventories, let's be careful and honest. Big reported totals can coexist with tight float, and you must resist the temptation to turn every inventory print into a prophecy. What matters is change at the margin and the constraints on mobilization. If a major hub shows holdings rising, that doesn't automatically mean no problem. It could mean metal arrived but is committed. Or it could mean reported totals include categories that aren't practically available to meet sudden demand. Conversely, if holdings draw down, it doesn't automatically mean doom. It could mean metal is moving to where it's needed, which could actually reduce stress later. The point is not to cherry pick. The point is to track whether the stranded metal problem is healing. Because if metal begins returning to the benchmark hub smoothly, volatility can cool even if the macro backdrop remains supportive. That's one of the main counterpoints you need to respect. And yes, counterpoints matter because this market can humble anyone. One counterpoint is that extreme price spikes can ration demand quickly. If silver gets too expensive too fast, some marginal industrial demand can pause, substitute, or delay procurement. Not all of it. Some applications cannot substitute easily, but enough marginal behavior can change to take the edge off. Another counterpoint is that policy uncertainty can fade. If the reason metal moved and got stranded begins to unwind, clarity emerges on trade policy, tariffs, or regulatory risk, then arbitrage can get bolder, flows can normalize, and the market can breathe again. Another counterpoint is that volatility itself can scare off speculative flows, creating a sudden vacuum. When price stops being a smooth trend and starts being a whiplash machine, some funds step back. If the marginal buyer steps back at the wrong time, silver can drop hard even if physical demand remains decent. And another counterpoint is simply time. Tight markets can loosen when enough price incentive accumulates to coax supply into motion. The cure for high prices is high prices, eventually. The question is whether eventually arrives next week or next quarter. That's why your roadmap matters. So let's build that roadmap with concrete levels and behaviors without pretending we can predict the exact tick. Silver's recent path gave you a range you can actually work with. The low 70s area became the launch pad. The high 70s to low 80s became the battlefield. The mid 80s became the air pocket where liquidity thins and everything feels dramatic. In this kind of market, levels are not magic lines. They are zones where participants' constraints change. A prior breakout zone becomes the place where dip buyers test whether the move was structural. If silver pulls back toward those zones and demand shows up quickly, both on the screen and in physical behavior, that SA-controlled pullback and retest. It's the market exhaling without breaking structure. But if silver slices back through those zones with speed and you see spreads relaxing and physical premiums easing at the same time, that's the market telling you stress is dissipating. That would weaken the thesis that physical tightness is driving the warning. Because if tightness is real and persistent, pullbacks tend to be bought faster than you expect, and dislocations tend to persist longer than the skeptics want. Now, the other scenario, the one that catches people off guard, is continuation squeeze and gap risk. This is the scenario where silver doesn't give you a clean retest because the market is still short optionality, still underhedged, still dealing with stranded metal, and still seeing physical demand that refuses to cool. In that scenario, dips become shallow. Pullbacks get front run. The market trades like it's afraid to go down because going down invites buying that might not be easily satisfied. And then you get the ugly part, gaps, weekend gaps, overnight gaps, thin liquidity air pockets where the market jumps levels that everyone thought would be defended. This is why leverage is so dangerous in silver during stress regimes. You can be right on direction and still get taken out on a gap or a margin call. The market's favorite trick is to punish you emotionally for being early and financially for being leveraged. That's the psychology shield you need. Don't confuse being early with being wrong, and don't need to confuse a violent dip with a thesis break unless your proof stack breaks with it. Here's how volatility will try to manipulate you and how you can defend yourself. First, it will give you a spike that feels like validation. Then it will rug pull it hard enough to make you question your sanity. That rug pull is not necessarily a change in fundamentals. It's often a liquidity event. Stops cascade. Dealers rebalance. Funds take profits. The headline shifts. If you interpret every violent candle as the story changed, you become a puppet. Second, it will use social pressure. When price drops, the loudest voices will declare the entire move was fake. And when price spikes, those same voices will suddenly find a new reason it's obvious. That's emotional whiplash disguised as analysis. Third, it will try to bait you into all or nothing thinking. Silver rewards process, not certainty. Your defense is to anchor on signals that update slower than price. Spreads, availability, borrowing costs, inventory distribution, and behavior on pullbacks. Trend signal versus noise. Trend signal is the market holding structural zones and maintaining stress indicators. Noise is intraday chaos. If you can separate those, you stop donating your decisions to the loudest candle. Now, what should you watch next, right now, this week, to stay ahead of the next move instead of reacting to it? Watch whether the curve stays tense. When the front end remains bid relative to later months, it's a sign urgency is not gone. Watch whether talk of metal returning actually shows up as calmer dislocations. If the stranded metal issue is healing, you should see volatility compress and the market trade more smoothly, even if price stays elevated. Watch physical behavior. Do premiums and delivery times compress meaningfully, or do they stay sticky even on pullbacks? Watch cross-market signals. If regional pricing looks fragmented, arbitrage is either constrained or cautious, and that's a recipe for continued instability. And watch the way silver behaves around the prior breakout zones. Controlled pullback and retest is healthy. A fast failure that breaks structure and coincides with easing stress gauges is a warning that the squeeze narrative is weakening. But if price holds structure while stress gauges remain elevated, you have a market that is not done, it's just breathing. And that's where the real pressure starts, because breathing in a tight market can quickly turn into the next lunge. Let's also address the institutional skeptic angle without turning it into cartoon villainy. Markets don't need secret meetings to behave strangely. They only need incentives. Large participants manage risk. They hedge exposures. They chase liquidity. They avoid delivery surprises. When the system senses potential frictions, like policy risk that could affect trade flows, participants act in ways that make perfect sense for them and chaotic outcomes for everyone else. Metal gets moved. Liquidity gets conserved. Spreads widen. Volatility rises. And when volatility rises, risk managers tighten. That tightening can force behavior that amplifies the move. It's all incentive-driven. If you ever find yourself needing a grand conspiracy to explain a price move, you're probably missing a simpler mechanical explanation. In silver, that mechanical explanation is usually some combination of location, deliverability, and timing. And right now, the timing element is active, the location element is stressed, and the demand element is stubborn. That's a combustible mix. So here, as the practical lens I want you to keep for the next 1 to 2 weeks. Scenario 1, the base case. Silver cools off in a controlled way. It pulls back toward prior breakout zones, maybe shakes out late longs, maybe prints scary candles, but it finds buyers where it should. Spreads ease a bit, but don't collapse. Physical availability improves slightly, but doesn't suddenly flood. Volatility remains elevated, but starts to compress. In that scenario, the market is digesting gains, and the warning is still active, but not screaming. The what to do in that scenario is not heroic. It's disciplined. Respect the structure, watch the stress gauges, and don't let one ugly day convince you the regime is over. Scenario 2, the squeeze case. Silver refuses to give you the retest. It holds above key zones. Dips stay shallow, and a fresh push takes it back into the mid-80s quickly. Spreads stay tense. Borrowing remains costly. Physical behavior stays sticky. In that scenario, upside moves can be sharp and discontinuous, and the risk is not that you miss a perfect entry. It's that you get emotionally bullied into chasing at the worst time or leveraging at the exact moment the market decides to punish leverage. The what to do there is also not heroic. It's defensive. Understand gap risk, keep your position sizing sane, and don't confuse momentum with safety. Now, what would invalidate the warning? Because you always need an invalidation line, or you're not analyzing, you're believing. Invalidation doesn't mean price dipped. Invalidation means your proof stack breaks. If you see meaningful easing in term, structure, stress, normalization, and borrowing signals, improvement in mobilization that reduces dislocations, and a clear softening in physical premiums and urgency, all while silver loses and fails to reclaim key structural zones, then the thesis that physical demand refusing to cool is driving a supply warning loses power. That doesn't mean silver can't still be bullish on macro. It means the specific mechanism we're tracking would be less dominant. And that matters, because different mechanisms have different timelines and different risk profiles. A macro-driven bull trend can be smoother. A tightness-driven move can be jagged and cruel. Knowing which one you're in changes how you survive it. And finally, let's talk about the subtle but crucial identity piece, because it's not a begging CTA, it's a survival tactic. In markets like this, the edge isn't just information, it's temperament. The crowd will get hypnotized by headlines and whipped by candles. The institutions will do what their risk rules require. The media will chase whatever is loudest today. Your job, if you want to stay solvent and sane, is to be the kind of participant who watches the mechanisms, not the noise. Who respects volatility without fearing it. Who can hold two scenarios in mind without collapsing into certainty. Who knows that being early is not being wrong, and being right doesn't protect you from bad sizing. If you're the kind of investor who wants the plumbing, the incentives, and the what to watch next checklist instead of the emotional theater, stay with this community mindset. Because in silver, the market doesn't just test your thesis, it tests your psychology. And in the next week or two, that test is going to get louder, not quieter, because when stranded supply meets stubborn demand under a delivery calendar, the tape stops being a suggestion and starts being a demand.